And I want to throw up this chart to kind of get our conversation going. It is end of the quarter, and what a wild quarter it has truly been. This just taking a look at asset classes and their various returns this quarter. It's pretty easy to pick out where WTI crude sits on that chart, right? But fair to say treasuries have done very well. Gold has done pretty well as well. Everything else, not so much. My question is, if you see that we've kind of bottomed out, is that only for the next few weeks? And therefore, how do you invest if we know that more downside is likely to come?
Of course, when you talk about wild quarter, what a wild month. We've moved from a technical bear market into technical bull market within a mere few weeks. Certainly we are seeing bottoming in the equity market, and we are seeing incredible amount of opportunities in terms of good quality companies at very discounted price. Now, if you look at what has caused this, it's the virus infection state, and most of the economy are still in lockdown. Across the OECD countries. So it's very hard to see equity rallying away on the basis that the infection rate is still getting worse and the employment numbers continue to track lower. So on these basis, you can say that the equity has, although it's found the bottom, but it might go up and down and a little bit directionless and for the time being, for the next few weeks. But for investors, you need to take at least 3 to 6 month view. That good quality businesses with good balance sheets will thrive in this environment. And the government has stepped in, central banks stepped in with a lot of stimulus. As soon as we get this early sign of news and things are getting better and people can get out and spend those stimulus, those share prices will recover very quickly. So it's almost a case of just buying a good quality company and wait for the recovery.
So what are you preferring at this point? Are you going to stay overweight when it comes to healthcare, for example? Because we're all kind of trying to work out what a post-pandemic economy and spending trends and behaviours really look like, right? Will there be, I guess, greater focus and investment across healthcare sectors?
Look, absolutely. We've always long held overweight positioning in healthcare because it's a sector that is structurally growing and it's also very defensive. So it has a very good combination of those two characteristics. Now, with this post-pandemic world, as you mentioned, there will be structurally higher demand for a lot of those services, for ventilators, for testing facilities, and for demand for essentially health services. So we think these businesses will do well. So it's important to continue the overweight position in this space. But of course, they have done very well. There's also other companies that's been sold off meaningfully. Once we move past the pandemic, some of those really cheap businesses or good quality businesses will potentially do a lot better than what the healthcare businesses will deliver on a 6-month view.
Your comments echo similar comments that we received from Goldman Sachs as well today, where they're really looking at companies with reasonable payout ratios, where the healthy balance sheet can sustain a high dividend yield, even as companies around us continue to cut some of their dividends. So where specifically are you finding those companies with reasonable payout ratios with high dividend yields?
Look across the Australian market, for example. Take that for example. The highest dividend yield you see across resources, the material companies, and then you see across financials. And now, of course, on these two bases, and on the basis the economy continue to weaken because of the shutdown, the resources businesses look very attractive, and they have performed quite well relative to the financials. So these will where you will find the yield. But for me, I have a strong preference for quality businesses that deliver structural growth. So I tend to use those opportunities to really find companies that will deliver significant growth at a very discounted price. And many of them have been sold off significantly, and that's where I find my opportunities.
Jun Bei, are you being opportunistic on tech right now? Do you think valuations have come down enough for that to be attractive?
I've always liked tech, and to be honest, if you look at the performance of tech adjusted for their volatility, they actually perform pretty well relative to the market in the past 4 weeks. So in terms of value, this is not where you find value, but you can find relative within the tech sector, some with more discretionary exposure, consumer exposure. Tech has been sold off far more, and that is where you will potentially find your opportunity. But you have to take a longer term view, because those businesses you don't buy for 1 quarter earnings, you buy for 5 years, and that's how you find attractive investment opportunity at the moment.